Jason Zweig, thank you so much for joining me here on The Long-Term Investor.
It's my pleasure, Peter. Thanks for having me.
And we're in a special location in the New York Stock Exchange, which I think embodies so many different emotions when you're on the floor, when people see it in pictures. The third edition of The Intelligent Investor has just been released. What do you think it is about a place like this that embodies some of the timeless lessons and some of the philosophy that Benjamin Graham gave to us all so many years ago?
Well, I guess the place I would start, Peter, is that it's a lot quieter here than it used to be. In fact, it's quieter here today than it was in 1914 when Benjamin Graham first came to work on Wall Street. There's less physical human activity on the floor of the New York Stock Exchange in 2024 than there was 110 years ago. Think about that. So what that tells me is that, of course, the volume of trading in stocks has exploded thousands-fold. More shares trade probably in a minute than traded in a month when Benjamin Graham was here. But still, what investors need to do, I think, is ask themselves, what is the purpose I'm trying to achieve? Why am I an investor? And the chances are it should have very little to do with the daily comings and goings of the stock market behind us.
Well, and it's funny, less people on the floor, but maybe more market participants than ever before.
Totally.
And so much is, even I'm looking up ahead and I see the colors and I see the tickers moving across the screen. Mm-hmm. I wonder, what makes this book still relevant to investors today in a world that so much has changed?
Yeah, so I would argue it's more relevant than it's ever been. Graham originally wrote the book in 1949. He died in 1976. He's been gone almost a half century. The last edition of the book came out in 2003. But, just pause for a moment and think about it. We live in an age where it's never been easier to invest. You can invest with a single swipe of your index finger. So it's never been easier to invest, and it's never been harder to invest intelligently, because you can invest with the swipe of your index finger, and because your phone is constantly buzzing and beeping with alerts, and because the movement of stock prices has come to personify the market, and it's gotten very difficult to remember that those digits that are moving like the reels on a slot machine on your phone represent an ownership stake in an actual underlying business. It's not just blips on a computer screen or something that goes ding or generates confetti on your phone. And so more than ever, investors need rules and policies and procedures that can keep them focused on their long-term goals in a world that is just intoxicated with the short term.
Timeless wisdom that you offer here, and it's a really big responsibility, I imagine, to be tasked. It's an honor, but it has to also be somewhat of a burden to update such an important and popular text. When you Google best investing books, this comes up every time. Yeah. If it's not number one because somebody's paid to sponsor above it, it's just basically always up there. Amazon, for those of us viewing, for listening, if you do it, this is going to be the book that comes up. What do you feel like is the process for you to look at the past edition, to look at what has changed, to make updates? Can you walk us through a little bit of that experience?
Yeah, sure. So, I edited the revised edition that came out in 2003. And the publisher and Graham's estate, his family, gave me very specific marching orders, which was leave his original text completely intact, change nothing, but provide annotations like footnotes. Mm-hmm. Not that many people remember all the railroad stocks of the 1920s or the mania stocks of the 1960s. So I had to footnote all of those things to explain them. And then for each of Graham's chapters, I wrote an accompanying chapter commentary, bringing it up to date, then primarily taking into account the dot-com boom of the late 1990s that went bust in 2000. So for this edition, what I decided I should do is reread all of Graham's chapters and never look at anything I wrote. So what I did was although I do most of my research online and I'm not really paper-based, I printed out each of Graham's chapters and read each of his chapters, and I never looked at a word I had written, because it's now over 20 years ago. So I started completely from scratch, using his text as my base and saying, all right, if I'd never written about this before, what would I say about this now? And so I took, to some extent, I took the dot-com bubble of 1999 and 2000 into account, but much less than in the last edition. And instead, I talked about the financial crisis of 2008-9, about the COVID crash, and then the meme stocks of 2020 and 21, and then, of course, the big decline in 2022. And I wanted to bring all of those newer events into the book to inform how people should think about their decisions today.
Well, there literally is not a better person to be tasked with it, and you did a brilliant job. I remember my original introduction to the world of Jason Zweig was from the second edition, and as I think I mentioned to you earlier, at the start of my career is just about the time you had started at the Wall Street Journal, and yet I just knew you as the guy who revised and edited The Intelligent Investor. So reading this time through, though, it had been 15, 16, 17 years since I had read the last edition. The thing that still sticks out today is Mr. Market, and how powerful of a narrative that is. In rereading a lot of the classic texts in the past year or so myself, you see Mr. Market being referenced. I'd love if you could just explain Mr. Market to us, explain how he still manipulates us today just as he has in the past.
Yeah, well, so he's right here behind us, Peter, all around us.
Yes.
So Mr. Market is this imaginary figure that Graham wants us all to think about. And the easiest way to think about him is to imagine that you own a small business. Maybe you have a video game production company. Maybe you own a dry cleaner or a bicycle repair shop, or an accounting firm or a law firm, or a registered investment advisor.
That seems relatable for me, at least.
Yeah, there you go. And what Graham says is every day your next door neighbor, Mr. Market, shows up and he knocks on your door. And he says, I'd like to buy your business. But some days he's in an incredibly euphoric mood, and he offers you way more than you know your business is worth. Other days he's miserable. You know, he's depressed. It's as if somebody died in his family, and he offers you a fraction of what your business is worth. And what Graham wants us to think about is, why in the world would we feel that we have to do business with that man? Some days he knocks on our door and he offers us a price that's reasonable. But a lot of other days his price is way too high or way too low. If it's too low, we shouldn't sell to him. And if it's too high, we certainly shouldn't buy his business. And there's a reason why that metaphor is so powerful, because it really personifies how you should think about the financial markets. But it's not how most people do think about it. Most people think that market prices are there to provide them with information. And what Graham says is, no, it's a service, but it's there only when it serves your interests. The rest of the time, you can and you should ignore it.
I love what you just framed up there at the end, that everyone thinks price has information in it. Maybe it's because we ram market efficiency down people's throats, but that isn't necessarily the same thing. One of the basic advantages is, as Graham discusses and you highlight throughout the book, is the fact that you don't have to be a price taker or pay attention to Mr. Market. Can you talk a little bit about that?
Yeah. So one of the phrases I developed in the book, Peter, is the difference between options and obligations. And by options, I don't mean options contracts. I don't mean stock options or index options. I just mean choices. If I give you the option to do something, you have the choice to do it. And what Graham wants us to realize is that market prices give us the option to trade. They do not confer an obligation to trade. And I think many people confuse the option to trade with the obligation to trade. Like if they see a price, they feel they have to act on it. And what he wants us to realize is if we see a price, then that gives us an obligation to think about it, but not necessarily to act on it.
Now, do you think there are, this is maybe like the original behavioral finance book in many ways.
Yeah.
Do you feel like there are any unique behaviors that have presented themselves among humanity, among investors today that aren't really addressed in the original text that are worth noting?
Well, I thought about that a lot, and I think the answer, I guess I'd answer it on two levels. It sure feels that way. I think it feels that way to most people, and it feels that way to me. But when I think about it, I think that's wrong. So here we are on the floor of the New York Stock Exchange, and I'll give you a pop quiz, and I'm not trying to embarrass you, but what was the annual turnover rate of the New York Stock Exchange in 1901?
Oh my gosh. I would think it's in the teens, maybe.
Yeah, that's what most people would guess.
Yeah.
But if I remember right, not that I was here in 1901.
We'll ballpark this, yeah.
I think it was 300%.
Oh, wow.
Until the late 1990s, there had never been a higher rate of annual portfolio turnover on the New York Stock Exchange than there was at the turn of the 20th century, 1901, 1902, 1903. And that's because American society was permeated with bucket shops. People were churning stocks like mad. It was the beginning of a new century, optimism ran wild, and the gambling instinct sort of moved from the racetrack to the stock market. And people gambled like crazy, buying and selling stocks. And, a 200% turnover rate basically means that people would hold a stock for, a few months at a time.
Right.
200 or 300% turnover rate. And, when you put it that way and you realize that the gambling instinct is part of what makes us human, the fact that we now express our gambling instinct on our phones through brokerage apps or through, sports betting apps, it's a new manifestation of an old inherent aspect of human nature. I think that's how I would put it.
Well, I'm going to dig more into human nature a little bit later in our conversation, especially when we're talking about your written work in Your Money in Your Brain, but a little teaser for people to keep listening along with us. One of the things that I find interesting when people talk about Benjamin Graham, at least in the circles that I run in, maybe not socially, but professionally, trust me, my social group doesn't talk about Benjamin Graham.
Mine doesn't either.
Yeah, they don't want to hear anything I have to say really about anything finance-wise. Candidly, they just want me to do pizza reviews on Instagram, of all things. But the Benjamin Graham, Warren Buffett calls this the greatest book ever. Benjamin Graham was Warren Buffett's teacher. He's often considered the father of value investing. And I think what a lot of people who are really well-read will realize that Benjamin Graham, near the end of his career, said, hey, like this stock picking stuff, this is too hard. There's too much competition out there. The thing that I only more recently learned from a conversation I heard of yours was just being reminded how often he was updating the equations he used in the book itself.
Yeah.
Maybe you could talk a little bit about what it is that he contributed on the security analysis side. I heard that you dodged a bullet in having to update security analysis yourself.
Yes.
But that was considered the Bible for people here on the trading floor. What has changed that made Benjamin Graham realize, and then I think you realized, it's just such a hard game to play and maybe one not worth playing?
Yeah, so I think it's important to bear in mind that there could have been more than one reason why Ben Graham hung up his spurs. I mean, if you think about, professional athletes, they usually retire because, they've lost their game, right? Or they lost their mojo. In Graham's case, first of all, he'd been managing money for something on the order of 40 years, but I think it's important to realize he was a very unusual character. You can make a strong case that Graham was, by any measure, one of the most brilliant people of the 20th century. And I think one reason he stopped investing professionally is because he was bored. I think he had run out of questions that interested him. He probably still didn't have all the answers, but I think he felt he knew all the questions. And so he just like washed his hands of it and quit. Kind of like, Shakespeare going off to Stratford and living another, whatever it was, 20 or 30 years. Like an athlete retiring in his prime. He wasn't that old. He still remained interested in the financial markets, but he put most of his money in municipal bonds, actually. Although at the very end of his life, he became a pioneer of what today we would call smart beta or factor investing, and built portfolios of dozens of stocks that shared common statistical characteristics. They were basically value portfolio. He was trading the value factor.
Sure.
And I don't mean trading rapidly, but he was building portfolios of statistically attractive stocks rated on the value factor. And but you could also tell his heart wasn't really in it. I mean, he did it. He found it interesting, but he had lost his zest for the game, I think, because he had done it so long, and he didn't feel he could think of new questions.
That's really interesting. I appreciate that perspective. And you reference the smart beta or the factor investing. Value investing means a lot of different things to a lot of different people. Certainly when you're value investing at the individual stock, academics will refer to value as cheap. Now, I don't know that many people who are excited to go buy expensive stocks, but let's just run with it for now. Typically speaking, the principles of value investing that Benjamin Graham explains in all of his work, do you feel like they still hold up today, given the changes that the world has experienced? And by the way, take value investing to mean whatever you want in any context there.
Well, yes and no.
Like most things, yes.
Yes,
Shades
and
of gray.
no,
Yes.
and no. I think as a philosophy and as a discipline, it makes a lot of sense. Why would you want to pay more than something is worth? People do it all the time, and of course, exactly what anything is worth is always at least partly subjective. But I think as a discipline and a philosophy, it's very attractive. It makes sense. And that's why historically it has worked over very, very long periods. However, it has not worked for the past 10 or 15 years for the most part, depending on how you define value and where you're operating. And there's an open question as to whether the world has changed. Maybe AI has, changed the playing field forever. Maybe the biggest growth stocks in the technology industry are just going to keep getting bigger. It's a winner-take-all economy or a winner-take-all stock market. It certainly has been for many years now. Is that sustainable? Will that go on forever? I don't think so. But I think I've been saying that for a decade. So I would advise our listeners and viewers to take that into consideration. I mean, every value investor has said the exact same thing over and over and over again, which is, this is unsustainable. Stocks can't trade at enormous multiples of their earnings indefinitely, and every year they become more expensive, and every year value stocks look less attractive. And I don't think it's likely that that will go on much longer, but it could. It's not impossible.
Now, I'm going to share my opinion, even though I usually don't in interviews, just to help bridge us to something I do want to ask. But when I think, in my day-to-day job, I'm happy for people to have an index portfolio. I'm happy for them to have a factor portfolio that maybe it emphasizes value, maybe it emphasizes other things like profitability or momentum, or some people believe in low volatility, whatever.
Yep.
The thing, when it comes down to it, there is no one strategy that works in every single period.
Of course not.
And for value investing, when I read the principles explained through the book, yes, Graham goes through some individual stock analysis, even in this text. And yes, a lot of the companies don't exist anymore.
Right.
I was happy that Emerson Electric existed still, because that's in my backyard in St. Louis. So I was happy that one made the cut and still lives strong. But generally speaking, investors, I feel like, that I work with, my job is to help them avoid mistakes and make bad decisions. And typically, those stem from misunderstanding what they can control, what they really know to be investing versus speculating.
Exactly.
You've been observing markets and writing on markets for decades now. Not to age you, but
I had hair when I started, Peter.
It's a badge of honor. How do you feel like that, one, what do you think your role is in helping market participants? And then two, do you think there has been any improvement in mass or in some segments versus others in what, how investors behave in this manner?
Yeah, boy, the second part of that question is really interesting. So my role is just to get people to think. That's really all I'm trying to do. In fact, I would circumscribe it even more. I would say my role is to get one person to think.
Successful. Trust me, you got me thinking. So well done.
Okay, good. But that's my goal each week in my column. Is I write for my high school English teacher's wife. Because years ago I was visiting them, they're lifelong friends of mine, and she said, "Oh, I read your column, but I can't understand it." And I said, "Well, so I'm going to try to, next weekend I'm going to try to write it so that you can understand it." And whenever I speak to her, I ask her, "Did you understand my column last weekend?" And she usually says some of it. So I'm figuring eventually I'm going to write one she'll really understand. And I'm really just trying to reach one person. I want to make one person think. I want to make one person reconsider. And I want people to learn something that they hadn't thought of before. And, I get a lot of feedback from people. usually angry. And what I always tell people, I say it more politely than this, but it's not my job to tell people what they want to hear. It's my job to tell them what I think they need to know. And so if I write something that doesn't agree with people's prior beliefs, they get angry. And, you know, all of the information we receive now as a society is just a gigantic confirmation bias machine. I mean, if you're a Republican, you tune out CNN. If you're a Democrat, you tune out Fox. And people do the same thing with information about investing. If they love growth stocks, they don't want to hear about value. If they like value stocks, they don't want to hear about growth. If they're active investors, they don't want to hear anything positive about index funds. If all they own is index funds, they think all active managers are idiots. And my job is to tell people that the world is more complicated than you think. And if something sounds too good to be true, it's not that it probably is, it definitely is. And there's something you're missing.
Yes. You know, as you mentioned there, you feel like part of your role is to help people appreciate something or see something that they didn't understand before. Do you think there is broadly something that the investor community as a whole underappreciates, either from a behavioral aspect or an investment aspect?
Well, I guess one message I've been delivering the professional investing community for a long time is that expense ratios of funds and the selection of funds, and even to some extent asset allocation, all those things are matters of basis points. You know, a few hundredths of a percentage point this way or that if you get it right or get it wrong. But the behavior of the investor, and frankly the behavior of the investor's advisor, is a matter of percentage points. And if you chase assets that are going up and you flee assets that are going down, you're going to do damage to yourself that you will not be able to repair for years or maybe decades, because they cut percentage points off your return and your wealth. And that's a message that I think a lot of investment advisors do understand, but I'm not sure that they're as good at implementing it in their own behaviors as they are in applying it to the behavior of their clients.
Very well said. I network with a lot of advisors. Some I know very well, some I don't. And I do think that sometimes the individual investor who is looking for help from a professional doesn't always fully appreciate that the advisor themselves suffers from all the same behavioral shortcomings that they do on their own, investing their own money. And I'll say even myself, Jason, I own one mutual fund, and it's 100% stocks. It's globally diversified because I don't trust myself. It's very easy to manage client money, but managing your own money, now there's new emotions that come into play, and you try to make. And I'd encourage anybody who's watching or listening to us, if you're doing it on your own, the key is really just to make some very, very good decisions, some well thought out decisions, and try to stick with those decisions as long as humanly possible.
Yeah. And I want to circle back, Peter, to part two of the question you asked earlier, which we talked right over, which was, have investors gotten better at, I think it was, processing information and managing their own behavior, right? And I think the answer is no. And I think the answer to all questions like that is kind of the same, which is, markets change, technology changes, investment choices change. It wasn't that ETFs are only 31 years old. there's many people listening or watching who are older than the ETF itself, who own nothing but ETFs. And if they were 30 years older, they'd have a portfolio full of all other kinds of things. So all of those things change over time. What I don't think ever changes, and probably never will, is human nature. I mean, we are designed by evolution to get excited when we should be skeptical and cautious, and to be aggressive when we should be cautious. And then the opposite is true. At the bottom of a market, when we should be stepping up to buy, our palms are sweating, our hands are shaking, we've got a headache, we feel sick to our stomach, and we can't bear the thought of buying when it's exactly the thing we should do. And I don't think that's ever going to change. And that's why the kinds of rules and policies and procedures that Graham spells out in The Intelligent Investor are so important, because if you have those guidelines in place, then your decisions are made for you by your rules, rather than you having to make ad hoc, spur of the moment, seat of the pants, impulsive decisions, because your intuition will almost always lead you to do the opposite of what you should be doing.
I'm going to paraphrase our mutual friend Morgan Housel a little bit on this, but when you're looking at history and you see these downturns, they looked like great opportunities, but when you're living through them in the moment or looking out ahead, they seem like risks.
Yep.
And yet they're really the same thing. A final question on The Intelligent Investor before we pivot a little, the conversation. For people who buy this third edition, whether it's the first time they've read The Intelligent Investor of any edition or not, what do you think people are going to get out of this? What actionable items or pieces of information do you think you're going to be able to walk away with to make you a better investor?
Well, I think it's very hard for any of us, Peter, to accept the most basic principle in the book, which is, Graham spells it out at the very beginning in the introduction. And he uses a male pronoun because
that's what they did then.
That's what they did back then.
Yes.
He says the investor's chief problem, and indeed his worst enemy, is likely to be himself. And that's the overall overriding message of the book, which is you are your own worst enemy when you invest. And what you need to do is you need to protect yourself from yourself and from the people who are trying to tell you what to do. And that includes, Wall Street brokerage firms. It includes the mobs on social media. And it includes anyone you look to who isn't strictly qualified to give you really responsible, careful advice. And through tools like checklists and watch lists and an investment policy statement and an asset allocation you can follow and dollar cost averaging and rebalancing and all these other sensible structures that Graham outlines in the book, you can protect yourself against the enemy within and the enemy without. And if you do have a financial advisor, you will work with that person instead of being at odds.
I really like that, and it's going to prompt me to change my mind and ask one more question. Okay. Something that I meant to ask you earlier. Why don't you define what it means to be an intelligent investor, either in your eyes or in Graham's eyes or in both? Mm-hmm.
Yeah, so Graham was very clear on this. You would think from the title of the book, he's talking about people with a high IQ. And of course, being human, you'll think he's talking about you.
Naturally.
Yes, intelligent investor. Oh, that's me.
That must be me, yes.
Yeah, that's me. But he's not talking about conventionally measured intelligence. He's not using it to mean you have an IQ over 150 or that you have to have a PhD or a CPA or a CFA or an MBA, no professional qualifications. What he says, and he's very explicit, is he says, this is a matter more of the character than of the brain. And what he really means to be intelligent is to be wise. You should be someone with common sense and good judgment. And instead, if you think about it, what Wall Street and social media are trying to do is they're pandering to your self-image of yourself as this super high IQ person with a lot of trading expertise. And they want you to trade zero-date options. They want you to become a day trader in stocks. They want you to think you can trade foreign exchange or crypto, and that you can beat everybody else, including people who have multi-million-dollar computers and gigantic research departments and are, an enormous microwave pipeline right into the floor of the New York Stock Exchange. And you can't do that. No matter how smart you are, you can't outsmart people with better equipment and faster computers than you. So it's important when you think about yourself as an intelligent investor to remember that one of the common sense definitions of what it means to be wise is to remember that you maybe don't know everything. And maybe actually your wisdom, the higher form of wisdom, is to recognize that often you're kind of foolish. I know I am.
I do too, but only because of people like you that I've been reading so long do I realize the more that I'm learning, the more there is to know.
Exactly.
An excellent point for us to take a quick break, and then the next part of this conversation, we're going to talk a little bit more about Jason's other works and some of your other viewpoints on markets. If you are listening to the podcast, please be sure to leave a review, like, subscribe, do all the things that help other people find this episode and let them learn from Jason's wisdom too. Jason, thanks again, and we'll be right back for part 2.
Thank you.